In today's video, my goal is to share with you a concept that changed the way I operate in the market and that I believe can also help you make better decisions in your trades. It's called positive reversal, a simple but extremely powerful technical analysis concept. This concept is described by American trader Constance Brown, and to use it, we'll only need a price chart and an oscillator. I use the 14-period Relative Strength Index, RSI, but other indicators like the slow stochastic can also be used. Take a look at the price chart below. On the left side, we have a price chart, and on the right, the 14-period Relative Strength Index. Notice that the price chart forms a higher low than the previous one, indicating an uptrend. However, the oscillator forms a lower low than the previous one, indicating a downtrend. This divergence between rising prices and a falling indicator is called a positive reversal. But why is it such a powerful signal? The higher lows show that the asset is appreciating, but despite the higher price, the indicator shows lower lows, indicating oversold conditions. In other words, although the price is rising, the market still considers it attractive, which may lead more buyers to take the initiative to acquire the stock. Notice that after surpassing the high of the bar that marked the low, the market makes a strong upward movement of about 10% in amplitude. To determine the exit point for the trade, I usually use the previous high, as it's a resistance zone where it's expected that strength will act significantly in that region. I also frequently use the alternate projection, exiting at the 100% target. Regarding the stop loss for the trade, I like to place it below the most recent low. I also use option strategies quite often, which we can delve into in other videos. It's important to note that the larger the time frame, the better your reading accuracy will be, as it reduces noise and short-term tensions. Finally, it's important not to confuse positive reversal with bullish divergence. Positive reversal is a trend continuation pattern, meaning the market is already in an uptrend, and the divergence between prices and the indicator suggests that the uptrend is strong and will continue. On the other hand, in bullish divergence, prices are in a downtrend while the indicator is in an uptrend, suggesting a trend reversal rather than its continuation. And have you heard of this pattern before? Have you used it in your trades? Comment below and let me know what other topics you'd like to see in future videos. Thank you for sticking around until the end, and if you enjoyed it, please like and share the video with your friends. See you next time.